Welcome to Limit Up, the weekly capital market podcast. My name is Don Collins. I'm a chartered accountant and business advisor of 30 years and a partner at Findex, a leading financial advisory and accounting services firm based in Australia and New Zealand. I'm here today with Ian Reynolds, trader and investor, former bank foreign exchange market maker, early investor in Bitcoin and tech founder. Ian, welcome again today.
Thanks, Don.
Ian, before we get stuck into things, and we'll talk about this later, you say there's a real war upon us, and it's not what we think. It's not US and Iran, and I'm not going to give anything away, but I also know that you question whether the US Treasury is involved. All sounds all very manipulative is the word. I think you'll talk about it further, but interesting discussion for later. Making money in stressed capital markets is tough, and a typical investment portfolio will often fail. The world is moving into really challenging times as the US tries to address US $39 trillion in debt, contradictory fiscal and monetary policy, internal conflict, and numerous wars. And the rest of the world starts to consider a new global reserve currency, a multipolar world, and aging demographics. So how can we understand what's going on in geopolitics and macroeconomics? Ian is here today with his latest press release, and as I said, a real war is upon us, and it's currency manipulation. Ian, please give us more detail on this.
Thanks, Don. Okay, well, I guess there were a couple of things that led up to this last week, apart from obviously the yen's continuing weakening and rise in interest rates over the last 2 or 3 years. Federal Reserve meeting on Wednesday came out and kept rates unchanged, which was probably as expected, but Mr. Walsh was addressing inflation. Any rate cut hopes are completely off the table at the moment. So obviously that would tend to push the dollar higher against the yen. Bank of Japan also kept interest rates unchanged on Friday, but they really needed to raise interest rates because inflation is higher. Their currency is weakening, and rates are pushing up as nobody wants to buy their bonds. And there are lots of reasons for this. It's not just a week. This is just the week that tips it over the edge. And of course, on Friday, after hours, i.e. after London's close, where a lot of liquidity evaporates, Bank of Japan came in and sold supposedly $60 billion against yen, i.e. bought yen. And of course, a 5% correction or appreciation of the yen. At the same time, the US Treasury was selling euros from their balance sheet and buying yen, supposedly. No one really knows. They put out a statement about it, which we'll go through in due course. But really, when you look at this, what is the real reason? And this is part of the press release. Why on earth would they do this? Especially, okay, Japan needs help. Why don't you just buy some yen against the dollars that you can print? You know, seems to be a pretty good trade, if you ask me. You print them for nothing and you sell them and you get some yen. But instead, they've sold some euros. Very strange thing to do. And they've named Goldman Sachs and Morgan Stanley as the FX counterparties, which they are absolutely on the list of FX counterparties for the Federal Reserve Bank of New York. But no one ever names them, right? So it's really strange stuff going on. But the reality is, every time Japan tries to support its currency by selling dollars, it will sell the treasuries, US treasuries, that it put those dollars into to start with. So selling its reserves, they bought some dollars or got some dollars somehow in the past, and they bought treasuries with it. So they have to sell those treasury bonds on the market. Here is Scott Bessent's way of not selling treasury bonds by selling euros and buying yen to help the Bank of Japan get the currency higher, but stop them selling some of their US treasuries, because US treasuries are backed up to the highest point in a long time, which we'll talk about when we go through the charts. So my view is this really peculiar action, statements and stuff like that, is about trying to save the US bond market from going illiquid, which is definitely worth saving.
So, with the US supporting the yen, does this suggest deeper stress in global currency markets?
Well, I don't think I know the answer to that question, but if we look at the inverse of it, and a lot of people in America go, yes, this is, why we're the world's leading power and all this stuff, right? But here we go. The Western world's most indebted nation, which is Japan. Their currency is getting annihilated. Rates have gone up from 0 to 4% in a very quick amount of time. And everything is still in free fall. So this is the backdrop behind the de-dollarization trade. Everything we've talked about, America being $40 trillion in debt, it's all the same thing. And all this stuff is happening on the surface to try and distract us from the real problem at issue, which is that America is bankrupt.
So, does that mean, with Japan holding such a large amount of US Treasuries, that it's a financial stability risk for the US bond market?
Yeah, absolutely. So they hold over $1 trillion of US bonds. At the moment, those bond rates are backing up because no one wants to buy at the current return any more of the bonds because there's so many of them. So we do not need $1 trillion worth hitting the street because every time rates go up, the indebtedness of the United States goes up significantly. So I think it's $1.2 trillion in interest payments alone every year. The last thing they need is markets putting rates up.
And so, if this intervention is real, can it work without a change in interest rate differentials between the US and Japan? You mentioned before neither one of them had moved their rates.
So in the last couple of years, 10-year rates in Japan have gone from 0 to 4%. So they have gone significantly higher without solving the problem. So the US doesn't care about Japan, no matter what it says, it only cares about itself. But it
Yep.
needs to fund all of the bonds that are maturing every year. So I believe in 2026, there is, or we're halfway through, $6 trillion of bond rollers that they need to re-borrow because they haven't got any money and they haven't got any income because they're spending more than they take in through tax. So it's a big smoke and mirrors exercise, but the big problem is indebtedness of the United States. And this is what happens when Nixon took the US off the gold standard in 1971. They couldn't pay their bills, so they had to do something else.
So, the bond market is now driving current policy then?
I think that everyone is looking at the bond market. Absolutely, you're absolutely right there. But we're also looking at currencies now as well. So if we went back to a conversation like 3 months ago, Don, we'd have been talking about chip stocks and all this sort of stuff, right?
Yep.
Now we're looking at the fundamental drivers of economies because
Yep.
if Nvidia stock goes up, who cares? Well, those are long or short of it, right? But that's the only people it impacts. I suppose it does take the whole index up or whatever, but it's not like importers and exporters and foreign exchange reserves and everything else that surrounds currencies and indebtedness of countries. So at the very highest macro level, it's all starting to look a bit iffy.
And so, your release talks about a war, and we're talking financial war. Does that mean that currency, bonds, and central bank balance sheets become geopolitical tools?
I do, but it's not countries against each other. It's the financial markets against the United States because investors don't want any more bonds at 4.5%. Thank you very much, because they've been buying them since it was 0, 1%, 2%, 3%, 4%. They don't want any more of them.
And more?
And
No, exactly right.
you can go and intervene in currencies or whatever, do whatever you like, but they still don't want those bonds. And coming is, I think, yield curve control when basically the Federal Reserve has to buy all the bonds of the country, which is exactly what we've had in Japan that has got Japan into this state, is that the Bank of Japan ended up buying, I think they own 60% of the Japanese bond market.
Well, that's a large large number in anyone's language. Is there anything else you wanted to highlight out of this week's release?
I think I'll just leave it at that because it's a real pivotal point, and the central banks might win the battle of Friday, but will they win the war?
Yeah, we shall see. So let's move on to those financial market charts and see what happened last week up until Friday.
Well, let's start with currencies because that is the biggest bang. So this is the dollar, the Dixie, the futures, mostly against the euro. So it has gone down from 101 to 99. So it's gone down 2%. That's a lot. This is dollar yen. This has gone down, as you can see, 5.3% in the last few days, few sessions. So, and we've watched the Bank of Japan do this, Don, for the last year, right? And every time it goes down, it goes straight up again. And the 200 moving day average is capturing nicely the move at the moment. But every time we've seen it, and if this is a big intervention, it's gone down 5%. It's a lot, but they'd want to see it down. It's 156.45 at the moment. I really think that if they think they've got anywhere, they'd want to see it below 150, because at where we are now is back where we were in February. So, or in fact, it's back where we were in May. So, right, we put it back 3 months. Where is it going to be in 6 months? More intervention? I don't know. To be fair to America and the US Treasury, Euro yen got hammered for 4.5%, possibly on them selling it if they did, but equally because they were talking it in thin markets, and everybody that could get short on the back of it did. So undoubtedly there was some movement there. But if you look really, the Aussie, for example, barely moved. The euro itself, hang on, that was cable. Euro itself actually went up, but obviously the yen went down more than it went up. So net result, most importantly, dollar lower, dollar yen a lot lower. We'll see how it comes back. Real driver of all this, US rates. These are 10-year rates, and as you can see, since what date's that? End of June. Basically, rates have gone straight up. They've gone up from 435 to 470, 35 basis points. So that's a lot. Mr. Walsh has got a lot to do with this. More worrying, the 30-year has gone up from 480 to 525. So that's a little bit more. And these rates are now pushing back to 3 or 4 years ago highs. Big problem for Japan is their 30-year bonds here are now at 3%. How many times have we looked at them down at 0% and negative rates before? I won't bother going through that again. So we've seen that many times. On the back of that, though, interestingly, Bitcoin went up and then went down because there's been a hack of Cold Card, which is a storage solution that doesn't use the internet, and it's still got hacked by AI. It's a big worrying thing, right? So I think $85 million has been lost in that. Gold and silver, a lower dollar hasn't really propped them up as it should do. That's silver. We love gold, but I must say that price action is shocking at the moment. So yes, we've broken some levels, but man, it's not blasting off like we wanted it to. So possibly the sell-off in bonds is making everything really nervous, because if bonds, US 10 years break 470 significantly, go up to 5%, there's going to be some sort of big correction in probably risk assets, including equities. Here is the S&P. So we've had this weird cross shape. and it's telling us it doesn't know what it wants to do still. The Nasdaq is still under pressure. Those stocks that we've been watching go down, and this is SpaceX, which has got a month's trading or something. How many days is that? 12th of June. So it's actually had a month and a half trading. And Insider's got it to 135, IPO'd about 150 to start with, went up to 210, I believe it was. No, 225, and is now 108. So in certain places, there's a massive torching of capital. Remember how much issue that was? So that's probably $25 billion down the drain just on SpaceX. So everything, I would say, if nothing else, is very nervous.
Sounds very much like it, especially that last comment about the 25 billion.
Yeah, I mean, that's rather than the more arcane things like currency intervention, you can really see if investors have invested in SpaceX, they're taking a total bath on it.
Yep. And we get nervous elsewhere as a result. Anything else coming out this week of note?
We don't have any central banks this week, although we do have the Australian Central Bank the week after, but we do have non-farm payroll on Friday, and a lot of the markets not going down is predicated on the employment market not breaking yet, and we saw Mr. Walsh talk about this after in the Fed minutes. So if we get a really bad number, the market's price action is going to be terrible, especially for stocks. And as we've discussed many times, these numbers, you might as well flick a coin because it's so out of date, it's irrelevant. But when the market is teetering on the brink, it just needs something small to push it over.
Yeah, invariably does. All right. Nothing else for this week then?
Let's see what the action is. What happens? We could see the Bank of Japan intervene for weeks on end and really prove a point. I don't think they've got the nerve to do that, but we'll see.
Okay, we'll wait and see. Always interesting to look ahead and see what's coming up. Thanks again. Well, that's another wrap of this week's Limit Up podcast. This and previous podcasts can be located on the Siberia Capital website. Alternatively, you can subscribe by accessing the link at www.siberia.capital/contact. Ian, thanks again for this week's presentation and release. And thanks everyone for listening.